always good to listen to the guys that's operating on, I always call them food soldiers, because they actually operate on food throughout Africa. And Keillen was appointed head of Stanlib's listed property funds in 2010 and currently manages under 28 billion of funds, both institutional and retail clients. Thanks to successful and consistent investment philosophy and process, the listed property team has won numerous awards over the past decade, with Keillen himself becoming a regular media commentator not only on Stanlib's fund, but also on general listed property and industry issues. After beginning the property career with Standard Bank Properties in 2004, Keillen transferred to Stanlib the following year as a listed property analyst, on successfully assuming increased responsibilities and fund management exposure. He was appointed co-head of Stanlib's listed property funds and is a full-time fund manager in 2008. Keillen took responsibility for the Standard Global Emerging Markets Property Fund since inception in 2010 and continues to manage it. And you will also see that a substantial part of our offshore and local listed property funds is being managed by Keillen and his team at Stanlib, which is owned by the Standard Bank and Liberty Group. Keillen?
Thank you. Good afternoon. So today we're going to be talking about Africa listed property. By Africa listed property, we'll be referring more to the rest of Africa. I know I always say Africa, but we are actually in Africa, but our focus today is the rest of Africa. So it's quite an interesting actually space to be in. There's different perceptions about the continent. And when you think of Africa, you always think of this picture here with the Toyota Corolla. But when we went to Nigeria last year, this was a shopping center that opened, owned by Resilient Property Income Fund. You didn't see the Corollas there. You saw nice cars, probably proper Toyotas there. So that mall is doing quite well, lots of traffic in that space. And we move on to the office space as well. We've seen actually lots of changes in the market. Whereas a few years ago, this is kind of office space that you can get exposure to. But now it's changing. You're getting actually world-class actually offices with generators, with backup power, water as well, functioning lifts that actually work. Because you're seeing actually more corporates actually getting into the continent, and they need actually world-class properties that won't collapse like what we've seen in Nigeria over the last couple of years. So it's done by Axis a few years ago. And then move on to the retail space again. This is ShopRite in Nigeria. It trades actually extremely well. That at some point they have to ration the amount of stuff that you have to buy. They limit people to 1 or 2 loaves of bread per day, depending on the supplies. But see, everything I'm talking about sounds positive. Yes, there are actually negatives. So the lower lights will be on the left-hand side. That's Boko Haram. We've got the Nigerian Naira as well falling. The Ghanaian Cedi as well actually suffering. And also oil price. But most of these negative issues, they're not actually only related to Africa. They apply to the rest of the world. I guess probably one that comes up, which is quite unique, will be Ebola. But most of the nations have been declared Ebola-free. And so things are changing. But on the positive side, the fundamentals, when we take a long-term view, as the professor mentioned, that Africa for the next 25 years, it is the place to be. And the numbers actually do speak for that. Let's look at this chart here. This is South Africa. We've got about 52 million people, and then the rest of the continent, 830 million people. The number of office space, we've got about 15, 16 million square meters of office space in South Africa, whereas the rest of the continent has got less than 4 million, it's about 4 million square meters of office space. And in terms of shopping centers, we've got about over 20 million square meters of shopping center space, whereas the rest of the continent has got less than about 2 million square meters of shopping center space. So this is going to help to drive actually the property market going forward. So you can actually, this is more short term, but longer term we're buying into the story where the fundamentals really actually stake up. Let's look at practical examples. We look at Nigeria, West Africa, and then compare that to Kenya. Kenya is probably the second most advanced retail market in the continent, in Sub-Saharan region. Nigeria's got about 235,000 square meters of retail space. So 235,000 square meters is equivalent to, it's actually smaller than 2 mainland shopping centers in the whole of Nigeria. Ghana has got only about 100,000 square meters. That's smaller than mainland shopping center. Yet these economies are still growing. They're still growing 4%, 5%, 6%. Yes, they are slowing down, but there's huge opportunities. Kenya, which is the second advanced retail market, has got about 500,000 square meters of shopping center space in total. And let's look at the number of centers that actually have around the continent. Nigeria has got a total of 20 shopping centers or 20 malls. So Pretoria alone has got more than 20 malls, but the whole of Nigeria with 180 million people, 20 malls. And retail penetration is only 3%. We're at 60 to 70% retail penetration. So we mean like formal retail. So there are huge opportunities in these markets. We're sitting at 3, 4%, 2%. So Kenya, that's the second most advanced market, about 30% retail penetration. And the size of shopping centers, on average, they're smaller than Irene Village Mall, the biggest shopping centers you find in Nigeria or Ghana or other areas. So that explains why actually the rents are actually higher in Nigeria. So in Nigeria, you pay a lot more than South Africa, about $1,350 per square meter per year, where South Africa is about $314. But compared to, let's say, Hong Kong pay almost $47,000 per square meter per year. That's probably a completely different region. New York, $34,000 per square meter. So we see huge actual upside in these rents compared to these markets, because these markets are more saturated. You can't build more shopping centers in Hong Kong or New York, relatively speaking. And Nigeria actually, yes, there's been actually silence in the market activity last year, and it does reflect in this chart here. So last 12 months, there was not much in terms of new entrants into the retail sector, just Tommy Hilfiger, Revlon, and Ocean Basket, mainly because of the economy slowing down. But going forward, there's a lot of retailers actually looking to enter Nigeria. And these are all the names that we're actually picking up, talking to the brokers on the ground. We've got Brawl, we've got JHI. Those are the leasing actually agents talking to the retailers looking for more space. So when these economies turn around, there's a long actually waiting list for space in these shopping centers. And the other one is actually hotels. We do invest in some of the hotels in the portfolio, in the Africa Property Fund. And there's not much hotels in the rest of the continent. So you might not see most of the detail here. So you find that Southern Africa has got more than 100,000 keys or 100,000 rooms, whereas West Africa is sitting about 44,000. So they've got 4 or 5 times more population compared to Southern Africa, but actually very few actual hotel space. That's when you get to Nigeria, you pay at least 4 times the room rate that you'll pay here in South Africa. And so you pay a lot more because of supply issues. So we see huge potential as well in the hotel industry. But the biggest problem right now is the currency in the continent. You've seen actually lots of currencies depreciate against the dollar. The Zambian kwacha, 73% depreciation. That was huge actually last year, just last year alone. And Egypt, you've seen Egypt over the last 2 days ago, they've actually devalued their currency by about 12% or so. So we expect probably Nigeria as well, because they've got 2 currencies as well. They've got the official market and the black market. There's a huge gap between the official market and the black market. So over time as well, they have to do something about the currency. So Zambia was a bit worrying for us with 73% depreciation. So what we've done, went to do site visits, just go and see what's happening on the ground. So our model is to be on the ground. So we travel to Southern Africa, East Africa, West Africa every year to get a sense of what we're investing in, how it's doing. So you'll think that with the currency falling 73%, you may not get anything in the stores. So look at ShopRite, walked inside the stores, they're full actually, fully stocked, there's no space. You can't even find actual space to walk around some of these centers. And the parking is full as well. And interesting enough as well, look at the exchange rates. I wonder how much this guy actually makes money. Buys around at 0.68 and sells at 0.69. So still actually an active foreign market. It shows actually if the bid offer spreads are thin, there is actually activity in the continent. So ShopRite, the challenge at this stage is that they're paying rents in dollars, whereas their revenue is in kwacha. So when the kwacha falls 73%, it does affect their cost of operating. But they're still positive, as we can see from the stock levels in their stores. And about 60% of their stock comes from local markets, and then 40% outside. And then move on across as well in Lusaka, look at some of the new shopping centers coming up. So there's still activity, there's still new shopping centers coming up. And this mall is opening next month with 90% tenant commitment. ShopRite, Game, they all are taking space in this mall. So there's ShopRite store here. They're still unpacking the shelves and reorganizing the store. And going forward as well, we still actually expect more in terms of capital flows. So between 2007 and 2015, there was about $2 billion of equity that was invested in the continent in real estate. And between 2015 and 2020, we're looking at about $4 to $5 billion. And I guess probably 2020 is probably a bit far out, but what's important is the trend line. You're looking at over $15 billion between 2020 and 2025 going into the real estate market, from shopping centers to offices to hotels to industrial. And what's driving that is that because transparency is improving. So people are getting more and more comfortable with the continent. You're getting more data that's available. And I guess the most important thing is actually title deeds. So there's been actually concerns around Nigeria that you buy something and then following day, then you've got the grandmother or a chief coming and claiming that land. But what they're doing now, you're seeing actually lots of digitization in land registry. You're finding that in Nigeria, in Ghana as well, and in Kenya. So that's a priority for most of all these property markets. So it gives us more comfort as well when you invest going forward. But most of the developments or centers we invested in, we partner with the locals. You can't just go there alone on your own then. That's where you can actually get carried out and buy actually land that belongs to somebody else. So there's better actually transparency, and they're seeing more indices as well. Like before, there was no reference point in terms of where does the property market trade, what are the yields, what are the cap rates. So there's more data coming through with Brawl, with JHI, all these big international corporates investing more in the continent. But the biggest investors in the market, in the continent, is actually South Africans. South Africans account for half of the actually capital flows going into the rest of the continent. And the second biggest investors is actually the US. Americans and Canadians, they see actually exciting opportunities and they're willing to put in a lot more money. They just can't find the quality properties with scale to invest in. And coming back to the local companies, there was actually huge transactions, about $700 million last year of activity by local South African companies in the rest of the continent. And some of the names you'll be familiar with, we've got Attack and Hyprop. Attack, they own Mall of Africa, so they're diversifying as well, buying into West Africa and East Africa as well. And then Hyprop, they own Canal Walk Shopping Center, and they own Linwood Bridge as well. That's Attack Linwood Bridge, and then Mall of Rosebank. So they're diversifying the portfolios across the continent. And then Stanlib listed Fahari REIT on the stock exchange in Nairobi. It was oversubscribed, the first actually REIT to list in Kenya. And then Delta Africa, they invested across the continent. They're in Morocco, they're in Zambia, they're in Mozambique. And then SA Corporate, they own East Rand Galleria here close by, and they're diversifying as well the assets into Zambia. This is actually a list of the universe that we invest in the continent. So it's about 40 billion rand. So South African universe is about 500 billion rand. So the rest of the continent, you're looking at about 40 billion rand. And if you strip out Egypt, you're looking at about just under about 19 billion rand in terms of investable universe. And we invest across from Egypt to Zimbabwe, Mauritius, Nigeria, Botswana, Namibia. So basically most of the listed exchanges in the continent. So right now we were actually cutting exposure, reducing our exposure to Zim. We did well last year, but the political environment and outlook and economic growth not looking as exciting. So we'll be cutting down that exposure. So the interesting thing is that people always think that probably Africa didn't do well. They tend to focus more on equities and negative sentiment. When you look at the returns for the fund, our global property fund, so we manage actually 4 different offerings of Stanlib from developed markets, emerging markets, Africa, and South Africa. So our total AUM in the space about 25 to 27 billion rand, and Optimum they support our funds across most of our offerings. Africa property actually outperformed South African property, did about 22% versus South African property at 9%. Even emerging markets as well, slightly below emerging markets, and then developed markets about 38%. And this is our exposure. Botswana about 20%, Kenya 6%, and Zimbabwe is 16%. We're looking to cut down that to about 5% or less exposure and invest more in East Africa. So the trend is actually there's more interest in East Africa than West Africa at this stage. And how does actually Africa property compare to equities? Because when people tend to talk about Africa investments, they tend to focus more on equities rather than property. So this line here actually is a reflection of equity performance in the rest of the continent. So property actually outperformed equities by quite a huge margin over 1 year and 2 years. Probably 3 years, similar returns, but that actually explains actually how defensive property is, even in tough environments. Because retailers, they still have to pay the rent. They might be selling less than they were selling before, but they have to pay the rent. They have to pay the interest costs. So as property investors, you rank first in terms of actually the profits coming out from these companies. And where are the hotspots at this stage? Our portfolio is actually exposed to most of the exciting places. So the opportunity cities at this stage is, you look at Lagos, Nairobi, we've got Maputo, Lusaka, and actually even Addis Ababa as well, that's Kenya. So that's Ethiopia, but the Kenyan companies have got exposure to actually Ethiopia because of all that East African partnership. So we benefit more in that space. So Africa is a huge actually economy. It's a $7 trillion economy with 1 billion people, and we've got huge cities as well. 52 cities with more than 1 million people on average. And the key thing for us is actually the emerging middle class, 350 million people, and the consumption is about 60% of GDP. So going forward, you want to be invested mostly in shopping centers. So to conclude, where do we see the upside and downside in the property space? So most of that actually applies to most of the economies, let's say emerging markets on the downside. So the biggest issue was around land ownership, but that's being actually cleared up with more actually regulation coming through across most markets. Infrastructure, that's going to be a challenge over time, but you're seeing actually lots of developments coming through, mainly with the partnership with the Chinese companies building bridges and dams and roads. So that is actually happening in the continent. But the challenge is that the market is highly correlated to the commodities and oil markets. And we've seen probably the worst of the oil price. So we're coming off a low, actually a very high base in terms of growth. And we believe over time we should see the growth come back. On the positive side, urbanization as well. As people move to the cities, people have to shop, they need somewhere to live, and there's business activity that's going to drive actually hotels. And the REIT legislation, that's actually a global standard on how to structure property companies. It's happening in South Africa. It's been launched in Kenya, and Nigeria and Ghana, they're working on the REIT legislation as well. So that gives investors more comfort about these markets that we invest in. So in general, actually, there is some downside, but we see a lot more upside. If you take a 5-year to 10-year view in the continent, we see actually huge growth prospects in the property space. So I'll conclude by the quote by Robert Kiyosaki that real estate investing, it always creates actually wealth over time. That's your capital appreciation, and the cash flow is the distributions or dividends and rents are paid by the underlying property companies. So don't wait to buy Africa real estate. Just buy and wait for 5 to 10 years. So there will be volatility in the short term, especially this year with currency issues. But over time, we see actually huge growth prospects in the continent. Thank you.